All right, welcome back, everybody, to another edition of Nest Egg. Jewel Financial's Nest Egg. You guys did a heck of a job last week. Thought it was great.
It was fun.
Yeah, recap. Daniel talked a little bit about high-yield savings.
Where to park cash.
Where to park cash. So we got a lot of follow-up questions about that from clients. I think it's important to understand, I think you were referencing the bank account cash. So if you have emergency fund money sitting in your bank, which is where your emergency fund money should be sitting, he was saying that basically you could seek out different banks, right?
Yes, potentially.
That have a higher interest. And many of those banks don't have branches.
Yeah, I mean, typically any bank that's offering a high-yield savings is a online bank, which is a non-branch bank, not like your local Chase or here locally we have Central Bank, things like that. It's Ally or Capital One or American Express or Goldman, which don't have branches, but they do have online portals that you can sign on. They're still savings accounts. They offer higher yields because they're trying to attract money.
So if you are interested, some people just aren't comfortable with that. That's
fine, yeah.
That's perfectly fine. We've talked about, written about, and many people are taking advantage of this. We have started to help people here in our office doing laddered treasury accounts. And basically what that is, and I mean, it's been 20 plus years since people have gone out and actually bought a real bond, but is owning an actual treasury bill, which is less than a year, just the terminology is a little bit different, or a bond, which is a treasury instrument that is greater than a year. You open an account, Charles Schwab, we buy those bonds or bills, and we do it in such a way, ladder, L-A-D-D-E-R, where when one matures, you sort of climb out into the future and buy another one at a later date. So theoretically, you always have bonds maturing as the ladder evolves. Now, at present, the one-year treasury was approximately 4.8 a couple days ago. That has dropped considerably, I mean, in interest rate terms because of the news flow, which we're going to talk about in a second. But we don't know how long this will last. So I'm not an urgency guy. I always hate that. But when the interest rates spike, which was what we've seen, if you have cash that is sitting in a bank and you're going, I don't want to risk it in the market, no problem. And we haven't had this opportunity for years. It's not like this wasn't a year ago. This has been in the last several months, couple of months, basically, where you can now buy these treasuries and at minimum for the next year or so, get a decent yield. So if you're at all interested in that or have further questions, let us know. We may have to explain to you how a bond works because it seems like a lot of people, when you buy a bond, they're like, oh, wait a second, I don't understand. I bought it, it's at 97, and it's going to mature at 100. That's only 3. Well, it also pays a coupon. So there's some education that may have to go into it, and that's fine. I'm going to apologize for my voice. Clearly, I'm getting over a cold, so I'm sorry. Logan, since the three amigos are at play here today, why don't you give us a little update? What's been going on this week in the markets, the economy, the news, etc.?
Yeah, I mean, holy cow! It's been a crazy week. Obviously, we had the elections at the beginning of the week. We had kind of a cryptocurrency debacle and a big crash there, and then also we had the CPI data come out, which is kind of the highlight news, the news that is driving the market that has done so well the last 2 days, where we saw 7.7% year-over-year inflation versus the 7.9% that was predicted. The market yesterday had about a 1,200-point move on the Dow and had a 7% move in the NASDAQ. It was the highest move since spring of 2020, I believe, in the market. So,
which, if you remember those days,
yeah,
that was coming off the bottom. That was an unbelievable reversal at that moment. And that's typically what happens when you have significant declines followed by what could be significant reversals. I mean, we've seen 2 now.
Yeah.
We've seen 2 based on CPI in each instance.
Right, exactly. And then today we've actually seen follow-through, which is even bigger because most of the time when we've seen those big rallies come from CPI or data or news that's come out, we've seen the market kind of fade after that. But today we've had follow-through. We've seen the markets continue to rise, which is a really good positive sign.
We'll put a link in the underneath in the description or whatever. Logan had a great segment on TD Ameritrade News Station this week talking about a couple semiconductors and a phenomenal call. Not a recommendation, but nonetheless a phenomenal call just in watching the price action of some of these stocks, which is something that we do on a regular basis. There's something I want to touch on, though, because we glazed through a lot of this week, and we're doing a lot more video than writing now, but I want to make something very clear. The market was not upset with the elections. So the media will lead you to believe that the sell-off on Wednesday was a result of the elections. It was not. Traditionally and historically, markets love a lame duck Congress, which is what we're going to have. Now, I think market participants, many of them sort of felt that we would get this red wave, and certain groups would do very well. For example, if we get a red wave, well, then maybe we're going to see more drilling. We're going to see energy, so energy stocks might do very well, etc. Maybe we'll see some backing off of the technology issues, the regulations, etc. So technology may do very well. So Wednesday, to start the day after Tuesday night's elections, with many still undecided, but pretty understanding where it's gonna fall, the market was fine. And in fact, we saw areas like, alternative energy, financials, areas like that doing quite well. We saw other areas kind of coming in. It was a balanced market. It was fine. The problem with Wednesday, and we won't spend too much time on this, but we had a Lehman Brothers type event in the crypto markets. Crypto markets, cryptocurrency, Bitcoin, Ethereum, etc. They're run on exchanges, just like let's say a Fidelity or a Schwab, etc. Except these markets and these exchanges are not regulated. And ultimately, you had a sell-off that resulted in a liquidity event. We've seen this in general markets in the past. In our markets, the Federal Reserve, Treasury, taxpayers step in to bail out banks, investment banks, etc., because these are regulated investments. Well, this world is not. And this basically took down billions upon billions of dollars, real dollars. People invested dollars for these things. Many institutions have lost billions, and that resulted in a dramatic sell-off in the general market, and you watched it all day. You could see forced liquidation, companies that maybe have been losing billions and going, okay, we got to raise capital over here. That's what happened on Wednesday. Thursday was fascinating. The data that came out on Thursday, and I've started to see people talk about this. Well, it's 7.7. Who cares? It's still 7.7. There's a big difference going from 5 to 7.7 as opposed to going from 8.9 to 7.7. You're coming over the mountain. It's a totally different view, meaning we are now on the backside of inflation. And remember, the markets, particularly the bond market, have been pricing in not only a rise, but a steady leveling off at those levels. And this data says that's not the case. In fact, it was the biggest biggest CPI miss in history. And I saw someone state that we never had that in the 70s. And that was nice, because what have we been saying all along?
This is not the 70s.
This is not the 70s. So what happened? Well, the CPI was down. Immediately, the United States dollar fell considerably. Why? Because if they don't have to raise rates so aggressively, the dollar's going to decline, right? Interest rates, they dropped, bonds rose, and the stock market had a massive reversal in the areas that have been hard hit the most. That was in your technology, your growth names, etc. So it was an amazing move. Now, I will say this is the first time we have seen this on real positive news, at least positive for the economy. So our view is this could lead to a pretty decent run, at least into the end of the year. Now, greater big picture, and we'll end it here, is I actually don't think this stops. I think that ultimately we see further erosion in inflation. We probably see an uptick in unemployment. And ultimately, the Fed may have to reverse course, giving even more fuel to the fire. So we'll have to see how that plays out. Okay, we got a question. So I've asked you for this show to write us in a question. You can email us at nestegg@jewelfinancial.com. That's nestegg@jewelfinancial.com. We got a question. We'll kick it around. We'll go to Daniel because he hasn't said very much today. So currently invested in stocks down $100,000. Okay. We don't know the size of the portfolio here, so
Sure.
we don't know if that's 5. Let's say it's 12%, right? That's the average maybe percentage. So 12%. So we're talking what's that? $1.5 million portfolio or something along those lines. Okay, that's what I'm starting at. That right?
Let's go with it.
That's not right. That'd be an 800,000, 900,000. Okay. Wanting to invest in real estate in Florida. Do I stay invested? I'm assuming they mean stocks, and hope it comes back. That's what they mean. In order to buy property in Florida, I can put a deposit, but will need to borrow now that the stock market has fallen so fast. That's the best scenario. Would it be a major mistake to pull money now or reinvest in less volatile instruments? Now, in full disclosure, this was sent in last Friday before this week's market rally. So this person might be going, okay, I'm good. I'm good. But this is a true question, right? So if somebody has a portfolio of stocks that's now in decline and they wanted to purchase another asset, and maybe they were viewing this portfolio as their purchasing power, and they might be stuck between a rock and a hard place. So as the CFP, what would you say to this question?
Yeah, so if we were doing a plan to that regard, we would really look at, you're moving assets from one bucket to another bucket. Presumably, this is an investment property, or
that's what they said, but I know a little bit about the scenario. This will also be a second home, so it's not a speculative investment. So it's going
kind
to be
of
more
a little
of
bit of both, a hybrid sort of asset. It's not primary residence, is what we're getting at.
Right.
So primary residence is a little bit different. That's highly needs based. So you need it when you need it. You need it in the location that you need it, and so you kind of need to buy it when the time is right and the opportunity is there, unless you can do something else like rent or significantly downsize. But when you're looking at it as a investment asset primarily, or a hybrid sort of investment, second home, vacation home, etc., you're really moving assets from one bucket, which is your investments, and though we get quotes on those investments minute by minute, and so they appear much more volatile. You're moving it from that type of investment over here to this other investment property, which is not inherently less volatile. It's just that we don't get quotes on it all the time. And so it really comes down to a decision of, is now the right time for you? Is when you're looking at the property in Florida or anywhere else, is it priced in a way that you want to buy it compared to the asset that you're selling? And so there's no right answer to, just because your other asset is up, down, or sideways, whether or not you should sell it. It's really looking at both and going, which one do you value more now here? So if you fundamentally believe that stocks are down but are poised to go up, then you might go, I would rather hold stocks because their future potential return is better than the potential return over here in property. So you kind of have to make a judgment based upon the price and valuation of both, or talk to your advisor and have them help you with that judgment.
Well, one of the things that I want to draw into this is, if a $100,000 drawdown in an investment portfolio now mandates a mortgage.
Sure.
Okay, so let's say that there was no drawdown. So, I mean, let's just speak round numbers, and let's say that we got a $700,000 portfolio, and it's now a $600,000 portfolio. Okay, so if the question is, well, if I didn't have that $100,000 drawdown, I could use all $700 for a $700,000 house. Okay, so if it's $600,000 and you're looking at a $700,000 house, you're talking about a $100,000 mortgage or line of credit. Who cares? I mean, I realize it's a percentage, but big deal. Like, I mean, that doesn't seem like, it's not like, oh my gosh. I mean, if that $100,000 mortgage, if that's, because that's what we're down, am I saying? If that $100,000 mortgage creates financial turmoil, you can't buy a house in Florida.
Yeah,
like
fair enough.
that. I mean, you're talking, have you calculated the maintenance, the taxes, the insurance? Oh, by the way, flood insurance now in Florida. Have you heard? I mean, these things are skyrocketing for home ownership there.
Yeah.
So I think I would agree that you have to look at it from investment to investment. The other thing I will say is that housing traditionally follows later markets. So interest rates have spiked, stocks are down, and housing is still relatively firm. But that means that people sort of aren't having to do anything yet. And typically what happens in housing, and it may not happen this time, but what happens is housing is the same predicament you're in. Somebody who maybe can't afford a house is also in, and they're going, darn it, my 401k, I got laid off from my job. The thousands of people are, and now we got to sell our house. And now we don't have the luxury to price it where somebody needs to price it, right? So I think what I would say to this person, if they were sitting in the office, I would say, where's the house you want to buy? Well, here it is. It's right here. And this is what it's going to cost. Okay, that's what it's going to cost. Here's the portfolio. Then let's really run the numbers. Let's go get a quote on the mortgage. Let's look at the cash flow. What are the taxes, the insurance, the maintenance, the flood insurance, etc., and really get it. And then make a wise financial decision, not an emotional decision based on where stocks are, because assets are going to move like this. So if you're thinking, well, I got to get out of here and move over to here, the irony is you could get out of this, go into this right before it does this. And I saw people do that in 08 and 09, and that was not good. Oh, my stocks are down. I better pay off my mortgage. At least I know that's safe. And then their house went down 30%. Anyways, what do you got, Logan? You got anything to say there?
Well, I was just thinking, I'm glad you kind of touched on the macro view of housing, because I think as we talk and say we think the markets may ramp into the end of the year or have a nice finish to the year, I think people that are looking for a house may be worried about it getting as crazy as it was last year or as it was the last couple of years. So speak a little bit more on the macro of why does housing tend to follow stocks, as far as we had a huge decline in stocks. We've had a softening of housing. So do we think the housing market is just going to accelerate with the stock market, or is it going to take a while?
So I'll touch on this briefly. Stocks are typically a preliminary reading of the economy. Stocks will always precede where the economy is going. They will go down before the economy starts to turn down. They will go up before the economy starts to turn up. One of the reasons we've had problems with what the Fed is doing is that stocks and many other asset classes are falling considerably with inflation up here or the economy looking strong and the Fed taking action. And that's been frustrating because that's why they're going to be late. And they're always late, and they will always be late, and they're going to be late again. And so if stocks are proceeding where the economy could be going, stocks are going down, the economy could turn down considerably. That's what we're seeing. Now, this is where people get thrown off. Well, then shouldn't I sell my stocks? Interestingly enough, stocks often bottom at the beginning of a recession. That throws people off. Like, what? What are you talking about? Stocks have already priced it in. They start to bottom. They start to move up, and the economy starts to really decline. Maybe unemployment goes up, et cetera. Now, a double dip recession is a totally different thing. We don't have time for that. So as the economy starts to decline, that's where the hard assets, large hard assets, start to have problems. So my macro view is markets, nice little move here, and I think it's fine, and I actually think there's good value out there, and that's fine. I think interest rates are interesting, and I don't see them actually continuing up. I actually see them down. But I do think housing is going to struggle, and I think housing is going to come in, and I think there's going to be opportunities there. And the challenge will be, when stocks rebound, does someone want to take from their stocks to buy the real estate? Because here's what happens. Well, my stocks are so good, and real estate's on sale, but why don't I get both? That's not good. The reality is that probably a good opportunity to sell stocks and buy real estate. Full disclosure, my wife and I are looking for a property in Florida. I have no desire in the next 4 or 5 years. I will pay a premium to rent because the cost all around, insurance, taxes, maintenance, is not a value here, not even close. So I'll stay invested. That's me personally. Great question. Anything else?
No.
All right, that does it for another edition of Nest Egg. Please do not hesitate to send us a question, nestegg@jewelfinancial.com, and pass this along. We'd love to have other people check this out. Hopefully they find value in this as well. Make it a great day.